Hey everybody, my name is Carl Lindgren. I am the Director of Financial Planning and one of the wealth advisors here at Stabler Wealth Management. Just as we're approaching the tax deadline and right in the midst of tax season, wanted to come to you again this year with some 2025 tax tips you can't afford to miss. So I think to start off, we should look at 2024 tax prep considerations. Obviously, the tax filing deadline is Tuesday, April 15th. Something to consider, 2024 was a pretty good year for investors. We've had a little bit higher interest rates the last couple of years, as well as really strong stock market performance in 2023 and 2024. What that might mean for investors and for taxpayers is that there could be a little bit higher tax burden due to both higher dividends and interest, as well as potentially higher capital gains. You do have until the tax filing deadline of April 15th to make various prior year contributions, such as your contributions to a traditional IRA, a Roth IRA, looking at doing a backdoor Roth, as well as a health savings account contribution. And then for any of you who are required to take your first RMD, that's your required minimum distribution in 2024, if you turned 73 in 2024, you have until April 1st of 2025 to take that very first RMD, although you will need to take two RMDs in 2025. Couple other things to consider. So 2024 contribution limits. $7,000 contribution limit to an IRA, a Roth, as well as a non-deductible contribution. If you're over 50, you can contribute an additional $1,000. For HSAs, those are your health savings accounts. So if you qualify to contribute, meaning that you are covered by a qualifying high deductible health plan, you can contribute $4,150 as an individual. If you're on a family plan, you can contribute up to $8,300. And then again, you have an extra $1,000 catch-up contribution if you're over 55. Something to consider for a Roth contribution, and this is where that backdoor Roth idea comes in handy, is depending on your income, so this is your modified adjusted gross income. If you're making as a single filer over $146,000 for 2024, or as a married filer over $230,000, you might not be able to contribute directly to a Roth IRA, and so you might have to consider doing a backdoor Roth IRA. You should definitely talk to us or talk to your financial planner before you do that, though. So now as we're looking into 2025, we do have some updates. So the tax brackets and various updates were increased by about 2.8% for inflation from 2024 to 2025. We also increased the annual gift exclusion. This is the amount that you can give to another person without any reporting requirement. We also saw some increased contribution limits to various retirement plans. And then the government actually did add some additional catch-up contributions for anybody between the ages of 60 and 63. So we'll get into that in a little bit. For 2025, we still have 7 tax brackets, and we are still in the Tax Cuts and Jobs Act of 2017 regime for tax rates. And so right now you can see the updated 2025 tax brackets for single filers and married filing jointly. The standard deduction this year is $15,000 for a single person, $30,000 for a married couple. If somebody is over 65, they can actually take an additional standard deduction. Now for capital gains, we've got the pretty consistent 3 different tax rates. So 0%, 15%, and 20% on capital gains. Something to consider for capital gains is that ordinary income, that's wages, dividends, interest, ordinary income will push up your capital gains rate, and it will push up your ordinary income rate. However, capital gains will only push up your capital gains rate. It will not push up your ordinary income rate. Like I mentioned, the annual exclusion gift is increased for 2025. So from 2024, we were looking at an annual exclusion amount of 18,000. That is up to 19,000 for 2025. Just some ideas of what you can gift to if you're gifting to a like a working child or working grandchild's IRA. They do have to be working, and they are limited to that $7,000 limit. But you can also gift to potentially to a 529 plan, or you can just gift outright potentially as well, depending on what you're trying to accomplish. If you're just trying to get the size of your estate down, or if you're able to afford to be really generous with your funds as well. Looking in more detail at some of these increased contribution limits. So what you can see is that IRA contribution limits and Roth IRA contribution limits stayed the same at about $7,000. For 401k or Roth 401k limits, those did increase. The employee limit did increase by $500 from $23,000 to $23,500. The 401k max, not including the catch-up. So I'll go into the catch-up in a minute, but the max limit for basically employee and employer contributions increased from 69,000 to 70,000. Again, that does not include the catch-up contributions. For simple IRAs, if you're able to contribute to a simple IRA, that limit increased by $500 from 16,000 to 16,500. For SEP IRAs, very similar to the 401k, increased from 69,000 to 70,000. And then for health savings accounts for an individual, we saw a $150 increase from 4,150 to 4,300. And for families, we saw a $250 increase from 8,300 to 8,550. Something to mention, looking at the increased contribution limits for catch-up contributions, what you'll notice is a lot of these are staying the same, but some of them are being added for 2025 that weren't there in 2024. So for example, both the IRA contribution for over 50, the 401k contribution for over 50, and the simple for over 50, as well as the health savings account for over 55. Notice the difference in age for the health savings accounts. Those are all remaining the same, 2024 to 2025. However, what we're seeing is there's this additional catch-up contributions for anybody aged 60 to 63. So if you are turning 60, between 60 and 63 in 2025, you are now eligible for an additional catch-up contribution to your 401k of 3,750 or to your simple IRA of 1,750. And again, these are on top of the limits mentioned in the previous slide. Now, just kind of talking about some tax planning techniques for 2025. As always, we're always looking at potentially doing any Roth conversions. These are a great way to kind of lock in favorable tax rates and potentially protect against really high future required minimum distributions, as well as potentially allow your beneficiaries down the line to be able to take tax-free withdrawals depending on what their tax rate is. It's a really great way to look at multi-generational tax planning. Another thing we like to look at for planning purposes is if someone is charitably inclined, there's a lot of really interesting things we can do, both in terms of using what are called qualified charitable deductions or qualified charitable donations, also known as QCDs. So if you are turning 70 and a half, or if you're over 70 and a half this year, and you like to make charitable donations, talk to us about that. There could be a really good tax efficient way to do that. Another thing to mention is something called a donor advised fund. So if somebody is under 70 and a half or isn't able to make donations through these qualified charitable deductions, something to consider might be a donor advised fund, whereby you can really tax efficiently start to put money aside and use that money to donate to charity over time. It's a really tax efficient way to do that. Now, looking ahead to the 2026 tax sunset, again, so starting in 2018, when the 2017 Tax Cuts and Jobs Act was passed, they did build in a sunset provision into that law. And so the tax rates that we've been seeing since 2018 technically are supposed to sunset, and we're going to revert back to the higher tax rates that we saw pre-2018. Now, we're watching this really closely because Congress does seems interested in extending the current tax rates. They haven't done it yet, and so we're watching that very closely to see. Currently, the tax rates are set to sunset, but I think our expectation is that we will see the current tax rates continue. We're just waiting to see action from Congress on that. If we do see the tax rates sunset, like I said, we'll see an increased rate kind of across the board, and I'll go into that in a minute. We're going to potentially see elevated estate tax exclusions. Those right now are extremely high. For a couple, you have to have in excess of $20 million to even need to worry about it. We might see those cut in half. The SALT cap, so SALT stands for state and local tax. So right now, you may have noticed if you are itemizing your deductions, you are limited to only $10,000 of deduction for state and local taxes. That's something that was implemented during that 2017 Tax Cuts Act. And if we see the tax rate sunset, that will disappear. This is also something that Congress has talked about making disappear anyway, even if they do keep their current tax rates the same. They've talked about lifting this SALT cap. The child care tax credit might revert back to $1,000. Currently, it's at $2,000. And then the alternative minimum tax might revert as well. So looking at how that might actually affect you, we've got on the left-hand side what it looks like for a single taxpayer, and on the right-hand side what it looks like for a married taxpayer. And as you can see, not only are the rates themselves increasing, for example, 12 to 15, 22 to 25, 24 to 28, and so on, you can also see there's a little bit of an overlap. So just as an example, if you look at the right-hand side, married filing jointly, in the 12% tax bracket, right now you can show up to $96,950 at 12%. Theoretically, if these tax rates sunset, you would only be able to show up to $96,700 at 15%. So not only would you see an increase from 12% to 15%, but you'd also see on that $250 between the $96,700 and the $96,950, you actually would see that $250 be taxed from a difference of 12% all the way up to 25%. Obviously, it's not a huge amount of money, but you'll see that kind of that overlap a little bit across the board in the various tax brackets. And at the end of the day, it does all add up. So we just want to make sure that everybody's aware of that. But again, our expectation is that the current tax rates will continue. Congress has made every indication that they want to continue that. And so we expect to see that, but we're just waiting and we're watching Congress closely to see what they'll do. So with that, just want to say thank you for tuning in. If you have any questions, please feel free to reach out. We always love hearing from you guys. So otherwise, I'll look forward to talking with you again later.